Went on a bit longer than anticipated, despite talking faster than JFK on speed. Sorry about that.
Much as I'd like to take out a huge mortgage and buy stuff, there's something of a bubble going on around here. Any other suggestions for how to take advantage of this?
Well, as I switch on to my financial advisor mode, how do you make money in a positive inflationary environment? It's not easy, but it's not impossible. If you have a look at companies that did really, really well in the 1980s, what they tended in the late 70s, early 80s, they were tended to be sort of conglomerate trusts. So they owned a little bit of everything. It's like the Abu Dhabi Investment Corporation, whose unofficial slogan is, we own 0.5% of everything that isn't nailed down in the entire planet. And the idea behind it is that you don't know where the upside's coming from. So what you should be is maximally diversified. It's like an index fund, right? So basically anything at all that basically is internally diversified, so buying shares in companies that have that type of structure, is probably the best way of barbelling yourself against it. But ultimately, you know, investing in debt markets is probably a bad idea right at this point. But it's still so, you know, at the end of the day, with this paranoia that all inflations lead to hyperinflations, it's total crap. When I went through the book, I did the research on this. I wanted, because I'm married to a bunch of background information. I'm married into a bunch of Germans. Well, I'm only married to one, but the whole family comes with them, right? And my Schwiegereltern, as I like to call them, my father-in-law, Schwiegereltern, he's a classic German, right? So he's like 71 years old, he's retired, and he still saves. And I'm like, what do you, you'll die. What are you doing? Why are you so totally hardwired for saving? And he's totally paranoid about inflation. So I went and read a lot about the German hyperinflation, and it was deliberate government policy to stuff the French over reparations. I mean, they did it quite deliberately. And the weird thing about it was, after they did it, it ended in 8 months. And the entire economy was stabilized within 12. And then it grew for 5 years. And then what actually happened was austerity threw the economy off a cliff, and that's when the Nazis came to power. So we have this story about the least degree of inflation leads to some kind of infinity curve hyperconvexity where boom, off it goes. And it's simply not true. Post-war Europe ran positive rates of inflation with positive real rates of growth all the way through the post-war period until about 1980. So the inflation panic is there.
So I've heard like Krugman and others bringing up like Japan as an example to support these kind of arguments. Like, can you just talk a bit about how they were able to run a high debt for so long and things don't seem to be going off the rails?
No, absolutely. I actually think these guys are wrong about Japan. I think what goes on in Japan is actually deeply structural. There's a wonderful book by a guy called Sven Steinmo called The Evolution of the Modern State, and he has a chapter on Japan, and if you ever want to read, I think, the definitive story on Japan, this is it. He spent 2 years there on an Abbey fellowship and had access to top people. There's two books. There's Richard Kuh's Holy Grail of Macroeconomics. So basically what happens is Japan goes through a balance sheet recession. What's a balance sheet recession? Basically, your companies are delevering but don't want to tell anyone because if they do, there'll be a run on them. And everybody's complicit together because they've all over-borrowed. So basically, you have this kind of like slow bleeding that goes on as it's sort of monetized by the central bank and it ends up in debt. So you're not growing. And that's sort of like the obvious part of the story. The less obvious part of the story goes like this. Go back to 1986, there's a thing called the Plaza Accord. The Plaza Accord was when the United States turned around to its two major trading partners, Japan and then West Germany, and said, our exchange rate is too high. People are buying dollars, you know, we're doing well just now, and it's killing our exports. You guys are wiping us out. Remember the whole paranoia about Japan that went on, they were going to take over the world, all that. You ever seen the film Rising Sun? Michael Crichton, possibly the most racist film ever made in human history, but put that to one side. So Japan's going to take everything over, blah, 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 the rest of it. And then, of course, what actually happens is they do the exchange rate thing. The United States exchange rate goes down, the German one, the Japanese one goes up. Now, the Japanese economy is entirely export dependent. It's sort of like Germany on steroids, right? So what they do is they move their plant and equipment from the Japanese home islands out to the second-tier tigers. So you start to get investment in Vietnam, Malaysia, all these places, and they move the entire thing with the supplier networks, the whole lot. Well, the way that the Japanese welfare state was constructed, it was all in-house to the firm. It was meant to be cradle to grave, but the firm took care of you. Well, the firm's just broken the social contract. So how did people protect themselves? They wanted another asset they could have that would have a positive upside, that would retain its value, and they could sell it in their retirement. What did they buy en masse? Real estate. So you get the giant real estate bubble. The real estate bubble gets so out of control that it pops because the banking system can't support it. That collapses and that starts the recession. But the important part is the sociological story. You've got a cultural and generational shift because you've got a very old population who are now 45 years old facing unemployment with a very, very narrow safety net for the first time. So what do when the government gives them money to spend to stimulate the economy? They stick it under the mattress. It doesn't go anywhere. It gets hoarded. So the savings rate goes up. And where do they put the savings? In the post office account and in the bank account. And what do the bank and the post office do with it? They buy government bonds. So that's why you end up with this massive extension in debt. Now the thing is, the Japanese propensity to consume is really, really low, particularly the higher up the demographic you get. So 80-year-olds are not just buying bonds and then liquidating them in retirement. They're actually keeping them whole and handing them on to the next generation. So you've got an intra-generational debt transfer going on. So the story that basically, it's just a monetary policy story and, Japan did it, I think that's wrong. I think there's actually a deeply structural problem that's went on there, and it goes all the way back to the Plaza Accord. So that's my short version of Sven-Steinmo's argument, but I find it quite convincing.
How can an individual state in the EU, like Ireland or something, try to fix things for itself with all the constraints under it?
They can't. They're kind of screwed. Because you're in the euro. So once you're in the euro, it's a kind of a one-time game. Because the problem was, if you're Argentina and you tie yourself the dollar as they did, back in the day, back in late 1990s into 2000, and then they had a default. And they had a default because Argentina is the graveyard of all bad economic policies gone wrong. There's no doubt about that. But also because their major trading partner is Brazil. And basically the real had a 40% exchange rate gain and basically exclude all their exports, and the whole thing fell down. Now, because they were just on a peg, they actually still had their own domestic currency. So they could go, to hell with the peg, we still got it. And then you lock up the banks and people bang on the doors and all that sort of stuff. But you still have your currency. Ireland doesn't have a pound anymore. I mean, literally, the bits of paper don't exist. So if you were going to get out of the euro, just think about the complexity of this for a second. You would have to kind of like freeze time, right? Everybody freezes. Some kind of government agency with a time machine would freeze time. You'd go around, you'd vacuum up all the bills out of everybody's wallets, the whole lot, and you'd stamp them all or reissue them with a new currency, and then you'd unfreeze time, and then you would have an economic crisis. So just that alone adds a level of complexity to it, which makes it just incredibly difficult. Bigger countries like France and Italy can do this. The Italian economy, North Italy, is actually globally competitive, totally solvent, the whole lot. The South is a basket case, but it's a bit like the North and South of the United States. Anyway, but you get transfers across the region, that's what keeps it going. The problem is Greece has nothing to export. It really doesn't. It has olive oil, but so does Italy, and they can make more of it. Spain makes even more of that. When you buy your Evo and it says Italian olive oil, it's actually Spanish olives they've bought and they brought to Italy and then they grind them and call it Italian olive oil. So that's all zero-sum against itself. So if you don't have something to export, then the devaluation thing that you'll get won't benefit you because you don't have anything. And all you'll do is end up with hyperinflation because your imports become so incredibly expensive. So Ireland, Greece, Portugal, they are stuck because they've got nothing to sell. That's it. So they're kind of trapped in this worst of all possible worlds. Ireland is really screwed for a whole generation. The debt to GDP figures you see in Ireland are a big fat lie because they basically book services exports from this company as exports. So basically the profits from this firm go to an office in Dublin. Has anybody ever been to the office in Dublin? No? It's about 25 people who work there, right? And your entire corporate profits get declared through there because you only pay 12.5% tax. So that 12.5% gets booked as an Irish services export and appears in their balance of payments, right? Well, it's complete paper. It's nothing. It's complete garbage. And they also have all the bad assets from their banks that blew up in this thing called NAMA, which is a super bad bank, and that's never coming back, and that's off balance sheet. So when you add it all together, Ireland's actually worse than Greece. Just don't tell the Irish.
Speaking of people, what do you think about Iceland? How they dealt with their financial?
Iceland is a brilliant example of no good deed goes unpunished, right? Because, so when I started all this off, I was a member of this thing called the Warwick Commission on Financial Reform, and the crisis happens, and people are like, it's the shadow banks, and I'm like, what's a shadow bank? I mean, you did a little bit of catch up on this. So at first I bought the whole narrative of too big to fail, systemic interconnections, risk, the whole lot, blah, blah, blah. And by the time I finished the book, I said, no, I actually totally don't buy this. I think we should have let them fail. Oh, but what about systemic risk, all the rest of it? Well, I know what lost GDP is. I know how much unemployment's cost. I know all the rest. I know the real cost of not bailing them. And more to the point, the banking system, even though it's de-levered, is actually more concentrated now than it was in 2007. So Citibank's even too bigger to fail. And the European system is that on steroids. So you've basically given someone not just a banking license with a subsidy, an extortion racket on the taxpayer. And that's just, it is literally criminal. Best example of this, UBS fined $1.2 billion a few months back for doing terrorism financing and money laundering with drug dealers. Now, if you or I did this, we would be in the jail. They get a fine. Why do they get a fine? Because if you are an investor in an American or American licensed broker-dealer entity, a big bank, right, and one of their corporate officers is charged with a criminal liability, you are under legal obligation to withdraw your investments. So if UBS is actually criminally charged, or their senior officers are charged, and I'm CalPERS, CalPERS has to pull the money out. If CalPERS pulls the money out along with everybody else, what happens to that bank? So what happens to the system? So you're basically playing systemic moral hazard as a business model. This is screwed up beyond belief. So Iceland, to finish this one, basically let their banks fail. Now, a lot of the debt, most of the debt was externally held, so the cost of that went on to others. But here's the interesting part of the story. All of the super geniuses who were working in the banks engineering derivatives now had to get a real job. So what happened was the domestic economy, the real economy, rebounded because all these startups happened, because all these really bright people went, shit, I need something else to do. So they started doing all these new businesses which didn't appear before. They became a huge hub for online gaming because you can stick the servers in the ground and it's bloody cold, and you've got all the people with the math skills who can do the software engineering and make the whole thing work, right? So there were all these positive externalities of actually letting them fail. Their unemployment level is about 1 point higher than Germany. Compare it with Iceland, which is 14% on the official rate, and that's with migration going out. So the people who did this, the government that came in and basically allowed this to happen, it's been a bit tough. You know, they actually do things like pay back their debt and are fiscally responsible. So they've just been voted out. And the people who blew up the banks in the first place are now back in power. No good deed goes unpunished.
I don't know if you're familiar with what happened in Australia. I'm from Australia.
Oh, right.
But they appear to have largely missed the financial crisis. And there are two stories running. And I don't know if you know which one is anyway, they're competing. One is saying that, well, the government did spending and gave people money and they spent it and that saved the economy.
Right.
And the other story running is that, no, it's the mining boom. We just dig everything up, sell it to China. China went well, and it's nothing to do with what the government did. So have you got a view on that?
The second one is completely right.
Yeah.
And the way you can see this is you can't trade the Chinese currency easily because of capital controls, etc. But what you can do is basically look at the kind of like the shadow markets on the Chinese currency versus the Australian dollar. And they move like this.
Right, okay.
Right? And it's because basically Australia literally is owned by China. I mean, people say this about the United States, oh, China owns the USA. And it's like, well, look, only 17% of bills are actually owned by China. And it's brilliant because for the past 30 years, we've been giving them bits of paper that bear 2% net, and they've been giving us televisions. It's a sweet deal. I don't know why anybody would ever want to end it, right? It's brilliant for us, right? The Australian one's the other way around. They actually do own your assets completely. Because if it wasn't for the Western Australian mining boom and just all the commodities are sucking out at the peak of a commodity cycle, I mean, do you really think a house in Perth would cost 2 million Australian dollars? And it does, right? So it's totally that. It's totally the mining boom. So what that means is either the commodity cycle peaks or China slows down. Australia's in serious trouble. Now, the price to income multiples in Sydney are 13 to 1. Right? So you need to marry 2 people and have family money in order to get a house. Right? So it's not 3 times your income, it's 13 times your income for a 3-bedroom flat in a nice part of Sydney. That's a colossal housing bubble, and it's Chinese liquidity that's pumping it.
Yeah,
if that ever goes away, boom.
The housing bubble has never crashed in Australia, unlike everywhere else.
Yeah, absolutely. And you know what? All bubbles pop. It is just a question of time.
I was hoping you could talk a little bit about the BRIC countries and especially what Brazil needs to be doing.
Brazil needs to do what Brazil's been doing, which is awesome. So, quick primer on Brazilian political economy. For years and years and years, they had one of the highest Gini coefficients in the world. They were incredibly unequal. And they had a problem because wealth being so concentrated meant that the people who make effective investment decisions decided that their own economy was too risky because it would either be run by the military or run by the communists or run out of town. So they would take their money and they would put it in Citibank, which is nice and secure, and you get a lesser rate of return, but you don't matter because you own everything anyway. So that's the way it went on for years and years, until it got to a point where basically you had to spend so much money on private kidnap insurance and mining your house against the people who would try and kill you, that they did a deal with a guy called Lula. Lula used to run the Workers' Party. So the guy running the Workers' Party, the lefty guy, comes in and basically does exactly as I said at the bottom of that slide, Democracy is asset insurance for the rich. Stop skimping on the payments. So they did a strategy whereby they got BNDES, the Brazilian National Development Bank, to bank their lending portfolio, by the way, is twice the size of the World Bank, to subsidize domestic corporations so that they could multinational. So you got companies like Embraer, the aircraft company, there's a big cement company, others, that are now globally successful corporations. Because of that expansion, bankrolled by the development bank, what they do is they tax the companies on their earnings abroad, bring that back in, and they set up something called Bolsa Familia, which is the welfare state that Brazil never had. This has squeezed the income distribution like this at the same time as it's gone up, which enables the Brazilians to finally build a middle class. It empowers the middle class, and it disempowers the traditional landowning elites. So what you end up with, there's a little fix you do with domestically high interest rates to keep these guys happy. But what you've actually done is to engineer a kind of neo-developmental welfare state, which has actually been great for Brazilian growth and has actually brought down the Gini coefficient. Because of this, everybody wants to buy Brazilian assets, which is why the real's going up, and they're export dependent, so they're freaking out. So what they've done is they've put inward capital controls on inward investment. And usually the big fear is, you put your money in, they put up capital controls, you can't get it out, it's expropriation. They're doing it totally different. They're like, you want to come here? Dead easy. Pay a transactions tax and a deposit. Because if you're not coming in for the long term, forget about sitting here earning high interest rates just because you can. So they're making it difficult for that money to come in. But as a growth node in a big country, it is happening nonetheless. So the real's going up, the economy's slowing down. But what they've done over the past 10 years, I think, is nothing short of remarkable.
Jeremy, thank you.